What if you could invest in companies like SpaceX, OpenAI, Stripe, Databricks, Anthropic, or other high-profile private businesses before they ever reach the stock market? Most investors assume access only begins once a company goes public, but many sophisticated investors look at a private company long before that point. And in some cases, a significant amount of wealth creation has already taken place before the average investor ever sees a ticker symbol. By the time a company goes public, early investors may have already been involved for years. The valuation may be higher, the growth story may be more mature, and public market investors may be entering at a later stage of the company's development. In this video, I'm going to break down how qualified investors access private company shares before an IPO, how secondary markets work, and what SPVs are, and the risks investors need to understand before participating. Because pre-IPO investing is real, but the way most people think about it is usually wrong. Before we get into the details, if you're a qualified investor and you'd like help understanding how private market opportunities could fit into your portfolio, there's a link in the description where you can schedule a free consultation. We'll walk through your goals, your current strategy, and the types of opportunities you're evaluating so you can get an even clearer sense of whether this is part of the market that fits your situation. Now, to understand how investors are getting access, we first need to clear up how pre-IPO investing actually works. Pre-IPO investing isn't just for venture capital firms anymore. When people hear pre-IPO investing, they usually picture venture capital firms writing massive checks directly into early-stage startups. And yes, that happens. Venture firms invest early. They negotiate directly with companies, and they often commit millions of dollars before the general public has ever heard of the business. But that's not the only way investors are accessing established private companies today. One of the biggest misconceptions is that you need tens of millions of dollars, Silicon Valley relationships, or direct access to the company's founders. That used to be closer to the truth. But today, a different market has developed. It's called the secondary market. And when this is one of the main ways qualified investors gain exposure to private companies before they go public. So let's look how they work. The secondary market creates access before the IPO. A private company may have employees, early investors, founders, or former executives who own shares. Some of those shareholders eventually want liquidity before the company goes public. They may want to diversify or take some money off the table, or they may have been holding the shares for years and want access to cash before an IPO or acquisition. So instead of waiting for a public listing, they sell a portion of their shares through a secondary transaction. That creates an opportunity for qualified investors to purchase exposure to private companies that aren't available on a regular brokerage account. This is one of the reasons pre-IPO investing has become more accessible than it was in the past. You're not always investing directly into the company through a new funding round. In many cases, you're buying shares from an existing shareholder who already owns them. That's the key. And once you understand the secondary market, pre-IPO investing starts to make a whole lot more sense. Now let's talk about why investors want access before the IPO. So why do investors even want this kind of access in the first place? Many of today's most valuable companies are staying private much longer than companies did in the past. Years ago, companies often went public earlier in their growth cycle. Today, private companies can raise billions of dollars before even getting listed on a public exchange. That means a company can grow substantially while it's still private. By the time public investors finally get access, the company may have already been worth tens or even hundreds of billions of dollars. That doesn't make the public investment bad, but it does mean that the public investors often entering late. Pre-IPO investing gives qualified investors a chance to participate before the public market stage. Of course, that doesn't guarantee success. Some private companies thrive, others stall. Some never go public, and some raise money at high valuations and struggle to grow into them. So this isn't about assuming every private company will become the next major winner. It's about understanding where the opportunity exists and how investors are accessing it. This brings us to how qualified investors actually get access. This is where the structure comes in. Even if you identify a private company you'd like to invest in, you usually can't open a brokerage account and buy the shares. Private companies don't trade on public exchanges. There's no ticker symbol, no standard public market order process. Private companies also tend to be selective about who can purchase shares directly. They usually don't want hundreds or thousands of small investors on their cap table. This creates legal complexity, administrative work, and operational friction. So qualified investors often access these opportunities through a structure called an SPV. SPV stands for Special Purpose Vehicle. An SPV is a legal structure created for one specific investment. For example, let's say an existing shareholder in SpaceX wants to sell a block of shares. Instead of multiple investors trying to purchase small pieces individually, a sponsor can create an SPV to acquire the shares. Investors contribute capital into the SPV. The SPV buys the shares, and the investors own interest in the SPV that owns the underlying shares. From the company's perspective, there may be only one entity on the cap table. For the investor's perspective, they get access to an opportunity they likely couldn't access on their own. That's why SPVs have become such a common structure in private market investing. They allow qualified investors to participate in specific private company opportunities without needing to write a massive check directly to the company. The company name is only part of the deal. It is at this point where many investors make the mistake. They focus too much on the company name. SpaceX gets attention, OpenAI gets attention, Anthropic, Stripe, Databricks, and other high-profile companies get attention too. But attention doesn't make something a good investment. The company is only one part of the equation. The valuation can change everything. A great company purchased at an unreasonable valuation can produce disappointing results. A lesser-known company purchased at more attractive valuation may offer a better risk-reward profile. Simply put, the name on the deal isn't enough. Investors need to understand the economics. What valuation are you entering? What share class are you being purchased? Are there transfer restrictions? What fees are involved? How is the SPV structured? What happens if the company raises money again? What could dilution look like? What is the realistic liquidity scenario? These are the questions that shape the actual investment outcome, and this is where we spend a lot of time with our clients. If you're evaluating private market opportunities and want help understanding how these deals actually work, there's a link in the description where you can schedule a free call. During the call, we'll help you think through the structure, the risks, the valuation, and whether an opportunity fits into your broader investment strategy. Okay, so let's keep going and talk about something very important, the risks behind pre-IPO investing. Pre-IPO investing isn't suitable for everyone. Private investments can be speculative. They're typically illiquid, which means you're not going to be able to sell whenever you want. You may have to hold the investment for years. There are also less information available than you'd have with a publicly traded company. Financial reporting might be limited. Valuations may be harder to verify. Market conditions can shift. The company may delay going public. And there's always the risk of losing some or all of your investment. That's why sophisticated investors usually view private investments as one piece of a larger portfolio. They don't bet everything on one company. They don't chase headlines or assume a recognizable name automatically creates a strong investment. They evaluate the opportunity in context. That means looking at a risk tolerance, liquidity needs, overall allocation, time horizon, and the rest of your portfolio. Private market investing can create opportunity, but can also create problems when investors commit capital without understanding the trade-offs. So that begs the question, why do investors still look at private markets? Investors continue to allocate capital to private markets because the potential advantages can be very meaningful. Not only can qualified investors gain access to companies before they're available in public markets, but they may also diversify beyond traditional stocks and bonds, gain exposure to innovation-driven sectors that are still largely private, and if a company eventually goes public, gets acquired, or completes another liquidity event, investors have the opportunity to participate in that outcome. Again, none of these are guaranteed, but these are the reasons why institutional investors have allocated capital to private markets for decades. The opportunity is real, but so is the risk. And the difference between the two often come down to the quality of the deal, the structure, and the investor's ability to evaluate it properly. What sophisticated investors look for before committing the capital. When sophisticated investors review pre-IPO opportunities, they look beyond the headline. They want to understand the business, the management team, the revenue growth, the competitive position, the financial strength, the market opportunity, the valuation, transaction terms, fee structure, and the pathway to liquidity. The pathway deserves attention. How could investors eventually get liquid from the investment? Could there be an IPO, an acquisition, a future secondary sale, a tender offer? No one knows for certain, but investors should understand the potential paths before committing capital. Because if there is no clear path to liquidity, the investment may take far longer than expected. This is why education is valuable in private markets. Headlines tell you which companies are popular, but they don't explain how the investment is structured or show the fees or the share class. They don't walk you through the risk. and they don't tell you whether the opportunity fits your personal financial situation. That responsibility falls on you, the investor. As private markets continue to evolve, more qualified investors are realizing they need a stronger understanding of this part of the market. Companies are staying private longer, secondary markets are becoming more active, and institutional participation keeps growing. That doesn't mean every private company investment deserves attention. Far from it. But it does mean investors who understand the landscape can evaluate opportunities with more clarity. They can separate access from quality, recognizable names from stronger economies, and they can make decisions based on structure, risk, and fit. So when you step back, pre-IPO investing comes down to more than just access. Secondary markets and SPVs can create a path into private companies before they reach the public markets, but the structure itself is only the starting point. The real question is whether the opportunity makes sense once you understand the valuation, liquidity timeline, fees, risks, and how it fits into the rest of your portfolio. The goal isn't simply to own a piece of a famously private company. The goal is to understand what you're buying, how you're buying it, and what the risks you're taking. That's how better decisions get made in private markets. If you'd like help understanding pre-IPO investing, evaluating SPVs, or deciding whether private market opportunities align with your goals, you can click on the link in the description to schedule a free call. We'll walk you through the situation, answer your questions, and help you get a clearer view on how this part of the market works. Because access by itself isn't the edge. Understanding the structure, risks, and role the investment plays in your broader strategy is what gives investors a more disciplined way to evaluate opportunities. Thanks for watching, and I'll see you in the next video.